Great. So as people are still dropping in here, I'll give a quick introduction of what we have in store for you today. So we're talking about pricing tools from Excel to SaaS, what pricing tools are out there, what has been used in the past, and what are the different advantages and disadvantages. I mean, there are reasons why legacy tools have been there, and there's reasons why there's need for change, and we'll look at both of those sides today. Our speaker today, as always, is our founder and managing director, Ingo Reinhardt. So he will be talking us through this session, and I have the task to do a bit of a Q&A in the chat. So if you have any questions, do let me know. Do drop them in here. You can see the chat at the very bottom of your toolbar, and you can also anonymously ask questions in the Q&A if you want to. So all of these will be raised with Ingo at the end of the session. And Ingo, if we click through a couple of more slides. So Ingo is, as I said, our managing director and founder at Buynomics. He has over 14 years of experience in pricing and developed the Buynomics method. And I'm Paul, I'm the moderator today, background in consulting as well, and the first point of contact if you want to work with us. If you want to learn more about Buynomics, I'll give a quick rundown on the next slide here. Basically, Buynomics is a software provider for better pricing and revenue management decisions. Our approach is called the virtual shopper. So we have our proprietary AI, which helps you make more holistic and comprehensive decisions along your commercial top line. So if you want to learn more about that, why we have the best-in-class accuracy and how you can step change your game from Excel to SaaS with Buynomics, happy to discuss after this meeting. But now I'll hand over to you, Ingo, for a very interesting session on the different tools and pricing.
Yeah, thanks, Paul, for the introduction, and thanks everyone for joining our webinar. Really happy that you're here, and I think we have something interesting to share for the next half hour. As Paul said, if you have any questions, just shoot them in the chat or in the Q&A, and we're happy to answer these towards the end of the webinar. So today's session is really about pricing tools, ranging from very, I would say, more traditional Excel tools to more SaaS, software as a service, so online pricing software or RGM software of the type that we're building here at Buynomics, and we'll have a look at both examples during the session, and also look a bit about the differences and the advantages of each of the alternatives. So to get started, I think we found a real gem that we want to share as an opener. So we were looking for Excel pricing tools on the internet, and we've really found a gem, and I really encourage you to also look it up and play a bit with it. So I think it's on HubSpot web space. It's an Excel sheet that can be downloaded and really goes through all of the key pricing methods. And I think it serves as a good opener for this session. So it has competition-based pricing, value-based pricing, all of them. And when you then click at each one of them, and we have here the example of the competition-based pricing, really what it asks you is like to fill out the light green fields here. So it asks you about your competitor's price. What we put in is, let's say, $100. You put in your price, 110. So that would be the price at which you sell. And the other information that it asks you to input is your variable cost per unit, so the $50 we put in, and then the number of units that you're expecting to sell. And then what it gives you as an output is really that you are 10% more expensive than your competitor, 110 versus 100. And that's also your $10 more expensive than your competitor. And with this variable cost, you have a gross margin of $60. And if you sell 100 units, then you have revenue of $11,000 and a gross margin of $6,000. So I think the math is correct, but this is not very helpful, right? And because it doesn't really answer the key question, and we'll go into more details on these. So it doesn't tell you really what the right price is. Should you be 10% or $10 more expensive than your competitor? What happens if you're only 5% more expensive? What happens if you're cheaper, or if you're 20% more expensive? How does that, and that's always the key, one of the key questions in pricing, how does it affect the units that you sell? Will there be a large jump if you go below your competitor? So all the key questions are really ignored in this Excel tool. And really, if you want to play with it, so I think also the value-based pricing is really entertaining. It just asks you what is your customer willing to pay, and then how many units do you expect to sell at that price, and then it tells you how much revenue you make. So I think this is a good opener, and it also already highlights some of the challenges with oversimplistic tools like this ones, because they really ignore the core challenges that we have. So maybe to step a bit back in the history of tools in pricing, I think pricing is really, as a discipline, as old as money. So from the beginning, when there has been money, there was also the question, what's the right price for my product, or how much should I pay for someone else's products? So, and this really is from early on, is very closely related to the technology of making really the key computations. And I think if we look at more modern times, the key steps or developments were the advent pretty much in the 1980s of tools like Excel that really allowed users to systematically compute prices across a large range of products in our case. And I think from my professional background, the key next step is the phase we're in right now, pretty much in the 1910s and 1920s, with the emergence of a large range of different, typically online pricing tools that cover really a range of different tasks. And I think the key tasks in our experience are the ones that we put up here. I think I would say there are three main categories of tasks that are covered by such pricing tools. The first one is the collection and assessment of different types of data. These typically include sales data, your own, as far as it's possible, also your competitor data, including pricing data, sales data, so everything you can know about your own and your competitor, market prices and sales. Another key aspect that you're interested in is, of course, customer insights. So how do customers, how do they evaluate your products? What features, what brands, what product features do they value it, and how do they value them differently? And how does that really relate to pricing? And when you have collected really, and that this is also one of the key fields where technology can really help with price crawlers and other technologies, really gather the data and then really also assess the data. So when you have, for example, for different weeks, different price, you know your prices and your competitor prices, and you know your sales volumes, you can, in the next step, for example, compute price elasticities. That means you understand how many units you lose when you increase a price, or how many units you gain when you decrease a price. So that's a typical thing you can do with the base data. And then another aspect would be to understand also things like cross elasticities. How do your sales volumes change if your competitors' prices change, and so on, and vice versa. And also assessing customers' willingness to pay, often using different surveys, something like a conjoint study, where you understand, okay, the average customer values my product 5% more than that of my competitors, or how customers value differently different sizes of products or other product features. So that really, to us, is the first category. Really collect all the key market data like sales volumes, prices, product features, costs, terms, everything that's available, and then doing some gaining some basic insights from the data, such as a price elasticity and so on. The second type of solution or task you want to do with tools is really the optimization of prices and products. And for that, we have a range of methods. Some of them we already saw in this very simplistic Excel tool that we used to open the session. And typically these methods are something like a price elasticity-based pricing, where you use price elasticities to determine for example, how sales, revenues, profits change if you change the price. You can also, in the case where you have products that don't really depend on each other, so individual products, you can also use price elasticity immediately to compute the profit optimal price, which you have found when your margin times price elasticity is -1. So for example, if the price elasticity is -2, then the profit optimal margin is 50%. So if you have all the inputs, then it's really easy to compute the profit optimal price. Or other things like competitor pricing, where you look at how much more can you charge or less do you have to charge than your competitors, something like a cost plus pricing, where you use your cost and add a markup, or something like a value pricing, where you try to understand what your products are worth to your competitors and then price accordingly. If you're interested in more details on these different methods, we have a number of dedicated webinars that you can find, for example, on YouTube or on our website, that really go into more detail on the different pricing methods. One of the challenge, and also that's something we'll look into in a few minutes when we look at an Excel example, is then the question how to aggregate the insight from these different methods. So let's say you have a price elasticity based price, you have a competitor price, let's say from the price elasticities, you find the profit optimal price, that's $100, and your competitor price from the previous example was, let's say, $110. Then the question is, how do you combine these two? And there's, as far as I know, there's no straightforward way. In many cases, teams just take the average, for example, of the different prices. So that's always a challenge with many methods, how to combine these different methods. And the third type of solution, or the third task for these pricing methods, really is how to manage prices and offers. And that's typically important, not when you have a single product or you have 2 or 3 products that you need to optimize, or where you have price changes once or twice a year, but you have a huge portfolio. For example, you sell, as in this example, like ski jackets in different sizes and different variations. So if a large portfolio where you can't focus too much on each individual product, but you need something like a price structure, or you have offers that you make as a company with a large sales team, you have, let's say, hundreds of sales reps, and each one is making offers to customers, and you want to do that in a structured way, then of course those are typical applications for software, be it in Excel or as a SaaS solution, because it really allows you to set parameters centrally and then see the implications for a large array or large set of different products or different offers, where these rules are then applied. So this is in a nutshell, and if you disagree, happy to discuss towards the end, but these are, from our point of view, the key tasks that are being addressed by pricing tools, be it in Excel or be it as a software as a service, for example. We did, I think earlier this year, we did a survey among pricing professionals, and asked essentially how do you do your daily work in pricing across a large range of different industries, professionals from different backgrounds. And what we found is, and would also be interested to know how it is in this group here, we found that the vast majority in that example, in that case, 85% are still using Excel as the main tool, and SaaS solutions, be it rule-based or now with the emergence of AI and machine learning, I would expect this share to go up a bit, that this is still in the minority. And of course, this is something we want to address here also as Buynomics, where the solution we have is really based on this AI or machine learning technologies that we apply. So why is that the case? Before we answer that, of course, I think it's important to note that if you are managing large portfolios of data or large portfolios of products, that you have a vast amounts of data from different sources that are relevant. So you have, for example, product data that tell you what the features of the different products are, what the brands are, what the sizes of the product are, what materials they're made of, what use cases they address, and so on. You have typically sales data, so how many units did you sell on what channel at what price in per week or per day, per month, whatever the time unit is. You have, of course, cost data. You need to understand what your products cost in each period. Of course, particularly in the last year where we had the emergence of strong emergence of inflation, costs have changed massively from period to period. You have competitor data. Here there are huge differences between industries. In some industries, it's fairly transparent, where you can, for example, buy third-party data, where that also include your competitor sales volumes and prices, to, for example, B2B cases where competitor intel is very difficult to gather, as if you make an offer, like an RFP process, for example, it's really difficult to understand what the price is and what the service or the offer of your competitors is. So there are all these different kinds of data, and they are, as we saw before, so mainly been brought together in Excel solutions, and as we have in this example here. So that what we want to highlight in this very simple example. I think it's an example that we use many times in our webinars in different contexts. But let me just explain how you can use the information and also apply the different pricing methods in this example to come up with a price recommendation. So here we are selling peanuts in different sizes from 1,000 grams down to 250 grams. And also we have two competitors, A and B, selling different nuts in different sizes and also at different price points. We know our current price, we know our costs, and we have, for example, using a regression analysis, computed price elasticities. And in this case here, it's all around -2. We have current units, revenues, profits, all of this we can compute, of course, with this information here. We have our current margins. And as I said before, also that if you know the price elasticity and your costs, you can determine the profit optimal margin, in this case, 50%, because price elasticity times margin is always -1 in the profit optimum. So that means that in this case, the profit optimum margin is 50%. And this already produces, using the costs, the optimal profit optimal prices given a price elasticity method. And from this, of course, also very easy to determine the new units. Given the old units, we have these price changes, and this gives us revenue and profit estimates based on this price elasticity and the price elasticity method. As we said before, there are different methods in pricing that use different inputs. We also want to add, I think we also did a survey on that. Value-based pricing is by far the most used method in pricing based on our research. And a way to apply value-based pricing is that you split up the different products. So we have our 4 own peanuts and the 3 competitor products into its key value drivers. And then based on those, determine the price. So we have as a value driver, in this case, essentially the brand. So here our own brand and brands A and competitor brands A and B. And we have the different sizes of the products. And I think a straightforward way to apply value-based pricing is have something like a base price that applies to all the products, and then add a markup based on the value driver and the different brands, and a markup for the different sizes that to determine really the value-based price. So, and in this case, our brand is a bit more valued than the competitor brands. So we have a brand value of 5, competitors at 3 and 2. That means the difference between the brands is €2 versus competitor A and €3 versus competitor B. We have these different markups for the different sizes, and if you add up these numbers as you would also in a regression model, you get these value-based price recommendations. If you then only look at the own price recommendations, you already see that there are, in this case, 18 versus 16 small differences between the two pricing methods, but there can also be much larger differences in some cases, here in the case of the smaller packs. And there is not really a good way to aggregate these methods, at least not that I have seen. So what's really been done in many cases is that people just take the average of the two methods, and then what we also then do here, we take the average and apply a little bit of behavioral pricing to go on the price threshold here, just below the €17, and this would be our price recommendation using these two methods. Different things to say about these. First, if you just apply price elasticity-based pricing, you get an estimate of the expected units, revenue, and profit, and you can actually do this for profit optimization. If you, and this is something that's very common in Excel models, apply this value-based pricing here, you don't really have an estimate of the sales volume. So you have a price recommendation, but you cannot say this is really the optimal price that comes out of value-based pricing. And of course, then the same with the combination with other methods, right? So these are already downsides of these different methods that are typically applied in such an Excel model, that it's really difficult to say if these prices here are better than the elasticity-based prices up here. And if you, for example, did the volume calculation or estimation using price elasticities, again, you would find that, of course, this combination is not as good as this one, because this one's given these price elasticities the profit optimal price. So there already we're seeing some of these problems with these methods if you combine them, and this is really, from my experience, how these things are being used in an Excel model. So why is that the case? I think the advantages of such Excel models are very straightforward. They are very flexible. If I have to set a price today for a new product, I would probably do it in Excel because it's really easy, straightforward. Everyone has it, so there's no additional cost. And it's really fast. And I would say also okay for rough estimates. If you just want to know what happens if I increase price 10%, plus or minus, it gives a decent estimate, I would say. I wouldn't use it if I have enough time and resources and data to put in for anything important, but just to get a rough understanding that's also robust. There, for those cases, Excel is really, I would say, a decent solution. What are the downsides? And here, just the most important ones. It doesn't really integrate. So if you have these competitor prices, for example, or the cost, everything you always need to essentially manually put into the tool. So it's not integrated with the database from which it would draw these different inputs. It's really difficult to scale it, which everyone probably has seen if you want to manage a large portfolio. For example, you have a large portfolio of spare parts. When in a company with many hundred thousands or more of spare parts, it's really difficult to do that in an Excel solution. Also, third point, that's the one that we highlighted in the example before. It's really difficult to put in a good prediction model. So how do sales volumes react to price changes, for example? In this exact Excel example, we particularly ignored the interdependencies between different products. And that makes really the prediction or the assessment of the effects of a price change really difficult. And of course, it's also difficult to learn in such an Excel model. It doesn't get better from iteration to iteration with new data. It really depends on the person using the model. That's why I think we have the emergence of pricing tools that play an increasing role. I think in our survey earlier this year, it was just 15%. I would, if we did it again, probably would expect there to be a larger share. And I want to just very briefly, I think we're already close to the end of the half hour, but just very briefly highlight what the alternative is from our point of view. The solution that we are building at Buynomics really is based on a new technology that integrates these different methods like elasticity, value-based, cost plus, and so on in a way that it really is integrated into a central model. And it does this by introducing what we call virtual shoppers. And the idea is, without going too much into detail, is that we create a large set of these virtual shoppers that collectively act as very close to real customers, so that if you change a price or make any type of change, if you show that to these virtual shoppers, they tell you very precisely how sales in reality would also react to such a change, and including switching between different products and so on. And just to show this, I think it's easier than to explain it. I want to show the same example that we just looked at in the Excel case. Paul, can you see my screen?
Yes.
So we have here the same example. So we have our four own brands from 1,000 gram to 250 gram. We have our 3 competitors. And here you can see we set up these products. We can choose the different sizes. You can put in everything that's relevant, the costs. You can also put in the trade terms, which are not relevant for this example, but you have all the details, price points, and so on. And then you show this offer at the different prices to these virtual shoppers, and you get exactly the same at the current prices, the same sales volumes that you have had in the Excel case. And when you then see, for example, you increase the price of one product, you see, because you only change the price of this one product, you have a very high price elasticity, minus 5.5. You lose sales on this product, and you see that you have interaction with the other products. So some of the sales that are lost in this one go to the alternative products, some go to a competitor. Small number of sales are completely lost out of the industry, but you can really see that you have these interactions. And of course, if you also reduce or increase the price of the closest alternative, their price elasticity already goes down. So this allows you really to assess the full complexity or the full dynamics of that market. And you can also, let's say, look at what would be the profit optimal price. In this case, it's if you increase the price of all the products by 60 cents, and this gives you a profit of roughly 48,000 euros. And just to conclude this example, if we go back to the presentation, well, you see my Excel again, my PowerPoint?
Yes, it's now just in the normal mode, so you just need to go presentation mode then.
Yeah. So just to conclude this, and I think then we're out of time. We A/B tested this example, 2 different sets, and saw that the estimate that came from the price elasticity in Excel was kind of off in its prediction. So the predicted profit 46,000 was much higher than the actual profit in the end, 34,000. Whereas in the forecast model that we had, because it considers all of these interdependencies, was then much closer to reality, leading to a much higher profit in this case. And this really highlights the advantages of more advanced SaaS solution versus these simple SaaS solutions in the example that we showed, or really simplistic examples that we showed in the very beginning from this HubSpot example, and really shows that particularly when larger amounts of money are at stake, that it makes a lot more sense to go for a proper SaaS solution than work with these simple Excel solutions. Paul?
Yes, thanks, Ingo. We're pretty spot on for the 3:30 Central European time, 9:30 Eastern time finish. And we have one remark. I think that was a bit early in the presentation. I want to interrupt back then, but someone was remarking that Excel is often used in conjunction with other tools. This person mentioning an e-commerce promotions engine to operate on top of the base price list. So I guess it's about not only combining different methods and having them sequentially behind each other to land at a point, but also different tools with probably different methods behind it. What are your thoughts about, I don't know, strengths and weaknesses of these types of tool combinations?
I think it's understandable that people work with different tools. Particularly, we have a tendency to make sure that we get it right. So, and that's also in the beginning why I said people take these, for example, often the average of different methods. If your price elasticity, your value-based pricing, and you do some behavioral stuff, that all leads to the same result, then that strengthens your conviction that you're doing the right thing. The problem is when they, as they often do, produce very different results, right? So you get from a value-based price of 100 and a price elasticity-based price of 150, right? So what you do then, and that's from my experience not uncommon that you have these cases. You always want that different methods produce the same result, and if they do, that's good, then it's probably right. But often they don't, and they don't because you often apply methods that are a bit rough, like estimating the extra value of a brand, estimate with one method, like a expert judgment, for example, and you estimate a price elasticity with a regression model that really largely depends often on the person doing it and how they work with the data. You put this together, it's not clear that they produce the same result, and that often produces problems.
Yeah, I think that's kind of the curse of the inflexibility of having, not knowing what to do with different types of data, but also not knowing what to do with different types of explanations for price, from value, from a elasticity, from a cost perspective. Yeah, so that's definitely something that I think resonates with a lot of our clients as well. I think that's all we have time for today. Ingo, we have another slide here because I do want to highlight a really interesting webinar coming up with our friends from Nestlé. So we have our expert webinar with the Senior Director of SRM, as it's called at Nestlé USA, talking about how to build an efficient RGM organization. So if you are in the consumer goods space, if you're building, your own teams, if you're scaling commercial operations, this is a webinar for you. I think, Jonathan, you put the link in the chat. So do register right away if you want to learn more about it. Otherwise, you can also follow us on LinkedIn to get all the updates and get access to that content. I think it's a really good one, and our first of many expert webinars to follow. So if you want to become an expert speaker, do also ping me on LinkedIn or by email, and we'll be happy to have a chat of how we can leverage your insights from the industry. And do give us feedback about, do you want more of these formats from industry leaders telling other industry experts about how they've done it? From our experience, from the feedback we've gotten so far, it's really something that many people are interested in. So looking forward to this one in 2 weeks. Thanks, Ingo. Thanks, Jonathan. And thanks all the participants today. And we'll see you in 2 weeks at the next web.
Yeah. Thanks, everyone. Have a great weekend. We're skipping next week because we're at the POI meeting in Dallas. For anyone who will be there, speak then. And otherwise, great weekend and see you afterwards. Bye.